Pre-incorporation expenses, those incurred before a limited company is officially formed, can be included in the company's accounts once it is incorporated. Pre-incorporation expenses are treated as business expenses even though they were incurred before the company legally existed. Here's how to handle them. 1. Reimbursement to the founder or directors. If the founders or directors incurred costs on behalf of the business before it was incorporated, the company can reimburse them after incorporation. The founder or director should provide receipts and documentation for these expenses. 2. Recording the expenses. Once reimbursed, the expenses are recorded in the company's accounts as business expenses. They may fall under categories such as legal fees, accounting fees, travel costs, or marketing expenses. 3. Tax deductibility. For tax purposes, these expenses are often considered allowable as long as they were incurred wholly and exclusively for the purposes of the business. However, there are some restrictions. Capital items like equipment can still be claimed but are typically treated as capital allowances. Any non-business related expenses won't be deductible. 4. Timeliness. Pre-incorporation expenses are typically limited to a reasonable time before incorporation, often no more than 7 years in the UK. HMRC generally accepts these as allowable if they meet the usual requirements. Practical steps. 1. Document thoroughly. Keep all receipts, invoices, and records of any pre-incorporation expenses. 2. Add to first-year accounts. Include these expenses in the first set of company accounts. 3. Seek professional advice if unsure. A professional accountant can help ensure these expenses are treated correctly for tax and accounting purposes. Recording these expenses can be beneficial as they allow the business to recognize its true costs of starting up and may reduce the taxable profit for the first year.